Hello friends, how are you doing? Welcome back to the channel guys. In today's video we'll discuss a very important mental model given to us by the late Charlie Munger. And we'll discuss this in the context of investing and making money in the stock market, right? So Charlie Munger, this great guy, he's given us a lot of mental models. All published in the book Poor Charlie's Almanac by him, which is towards the second half of the book, right? And these mental models are the frameworks, right? Or kind of frameworks for thinking, to think about things in life and in investing, okay? So today's framework is called Inversion Thinking. And this is the most important mental model given to us by Charlie Munger, Inversion Thinking. Now, what is Inversion Thinking actually means? So what Inversion Thinking basically goes on to say is that normally people, when they want to ask a question, what question will they ask? What stock in stock market? What stock can make them a lot of money? Right? This is the question which everybody asks. Which stock can basically go to the moon? But Charlie Munger and Warren Buffett became rich not by asking this question. They instead were asking the question, what can make them poor? Make them poor, and then to avoid it at all costs. And this is the very simple framework or the process or the way of thinking they implemented and used throughout their investing career. And we'll take a very simple example how they did it, right? With a practical investment they have done. But before that, I will share that how I also use it in my life now these days. So this channel is catered to new investors, right? New investors who are in corporate jobs and who want to invest their monthly salary into different asset classes, stock market being one of them. So how can a new investor lose a lot of money in the stock market? If you figure that out and do the complete opposite of that, we will by default make money, right? So if a new investor goes for picking stocks and they have the tendency to go to zero, some of the small cap, mid cap companies, right, small cap and mid cap companies can go to zero, basically go to zero on a scale of 0 1, they can go to zero. So if you avoid this is one trap. Second is assets who do not have intrinsic value, like a cryptocurrency. I get a lot of questions here. Cryptocurrency, if you avoid that, you will you'll be good. So what for a new investor is known to make money, right? It can take time, but it is known to make. Index is a basket of stocks. It has like 50 stocks, Nifty 50, and Sensex has 30. Nifty 50 has 50, and Sensex has 30, right? So this basket will never go to zero, and this is a self-changing basket, a basket depending on the market cap, right? Likewise, debt, fixed income, right? Debt will never lose its value. It will continue to give you the sum which is assured, and over that a return of 7 to 8%. Third is gold, which has some intrinsic value, right? Because of the physical gold, which is the source to guide the gold prices of bonds and ETFs, etc. So if you avoid this completely and focus only on these three asset classes, you will be good in the market. This is a simple way of thinking. How can a new investor apply this inversion thinking mental model? And by the way, this is not just limited to investing. This is related to mathematics. There was a great mathematician, German professor who invented this. Actually, his name was Carl Jacobi, and he has this quote, invert, always invert, which Charlie Munger kept on repeating. Now these guys these two investors actually applied this in their investing for picking Coca-Cola, which made them hundreds of billions of dollars. Right. Now most people don't understand that these two investors, these two great guys, did not actually pick Coca-Cola. They cancelled a lot of other drinks, and what was left was Coca-Cola. Right. And how were they cancelling this? They were using some criteria. For example, brand loyalty. Right? If a company does not have brand loyalty, it's gone. If a company does not have high margins, gone. Right? So they were consistently thinking for these things, like right. So if the customers who are buying this soft drink, right, they do not have loyalty to the brand, it was a clear no. The customer loyalty, very important. Customer loyalty, right? And is it a predictable industry or unpredictable industry? This particular drink, right? It's predictable industry. Soft drinks people will always want soft drinks, especially in the hot countries. So whatever drinks company was meeting, they were just cancelling out based on this criteria. And then the alternative which was left was Coca-Cola. Perfect example. Brand loyalty, amazing. High margins, right? Amazing. Customer loyalty. People will always use Coca-Cola, right, over any other drink, right? Predictable industry, simplicity of business model, So pricing power without a backlash. Even if the Coca-Cola were to increase 1 rupee on a bottle, people will give that premium to get a Coca-Cola. So these were the things they were doing, right? To buy, when they were buying this asset called Coca-Cola, and then they took a big position in Coca-Cola and they just sat with it, right? And it made them hundreds of billions of dollars. So inversion thinking is very important, guys. Fix a criteria what will make a company or a sector fail in the near future, and then go with the complete opposite of it, whatever is not meeting that criteria. And for new investors coming to the stock market, if you want to be rich, this is it. This is how you can apply. Stay away from things which can take you to zero. For example, F&O, futures and options, crypto, right? Picking up individual stocks, don't go for it. So go for index, go for mutual funds, go for debt funds, go for gold ETFs. So gold bonds are not available these days, but gold mutual funds you can easily go into. So these are the things you should consider as a new investor. All right. So I hope this was helpful. I hope you learned something. Thanks again for watching the video, and I will see you again in the next one. Till then, take care. Bye bye.